September 15th, 2008, 1:45 in the morning. A lawyer hits send on an email. One sentence. No drama, no apology. Lehman Brothers Holdings Incorporated hereby files for Chapter 11 bankruptcy protection. That's a fancy way of saying, we owe more money than we have. We're done. $619 billion in debt. Gone overnight. 8 million Americans would eventually lose their jobs. And the crazy part? It all started with a cotton shop in Alabama. You think you know this story. Greedy bankers, bad mortgages, bailouts, roll credits. But that's the lazy version. Here's what it leaves out. Who Lehman Brothers actually were, what they actually did for a living, and the one habit, repeated for 158 years straight, that made their collapse not just possible, but basically unavoidable. Rewind, all the way to 1844, Montgomery, Alabama. A young guy named Henry Lehman just arrived from Bavaria, that's southern Germany, and opens a small store. Pots, pans, fabric, basic supplies. Think of it like the 1844 version of a dollar store. His customers are mostly cotton farmers, and those farmers didn't always have cash, but they always had cotton. So Henry makes a deal. Don't worry about cash, just give me cotton. I'll sell it myself. Smart, because Henry quickly figures out he can sell that cotton for more than the farmer owed him. He's pocketing the difference every single time. In 1847, his brother Emmanuel joins. Then, in 1850, youngest brother Mayer shows up, and the name officially becomes Lehman Brothers. Not a bank, not a Wall Street firm. A family shop that was very good at spotting where the money was. That instinct, always follow the money, never get attached to one business, would be their superpower for the next 158 years. It would also eventually get them killed. Henry dies in 1855 from yellow fever. Emmanuel moves to New York. They helped found the New York Cotton Exchange in 1870, the official marketplace where cotton prices get set across the whole country. But by the 1890s, cotton is old news. Where's the real money now? Companies going public. Going public means a company sells little pieces of itself, called stocks, to regular investors. In exchange, the company gets a big pile of cash to grow, and somebody needs to organize the whole process. That somebody is an investment bank, basically a matchmaker. Companies that need money on one side, investors with money on the other. Lehman sits in the middle, makes the introduction, and takes a fee, every single time. In 1899, they do this for the first time. The stock sells out in one day. The fee beats an entire year of cotton trading. Over the next 2 decades, they repeat this for Sears, Macy's, Goodrich, Studebaker, often partnering with a little firm called Goldman Sachs. Then, 1929 arrives. Markets crash, Great Depression starts, nobody is taking companies public anymore. Lehman pivots, again, into venture capital, finding people with great ideas and no money, and giving them cash in exchange for a share of the business. High risk, massive potential reward. In the 1930s, this was basically unheard of, but it keeps Lehman profitable while everyone else is frozen. Corner store, cotton trader, matchmaker for companies, early stage investor, all before World War II. Post-war, Lehman keeps growing, but the culture turns toxic. Every department competes against every other department for bonuses, not in a friendly way, in a stab-you-in-the-back way. By the 1970s, employees have a nickname for the place, the Devil's Casino. One executive, Steve Schwartzman, calls it completely dysfunctional, quits, and starts his own firm. That firm is called Blackstone. Today, it's the biggest private investment company in the world. Lehman bleeds talent until 1984, when American Express buys them and folds them into a corporate blob called Shearson Lehman Hutton. For a decade, they're a mid-sized division, doing basic brokerage and occasionally making headlines for fraud scandals. American Express eventually decides the headache isn't worth it, and spins Lehman off as its own company again in 1994. Enter Dick Fuld. New CEO, lifelong Lehman employee, furious about what the American Express years had done to the firm, obsessed with bringing back the glory days, bigger, faster, more aggressive than ever. Under Fuld, Lehman borrows enormous amounts and rebuilds every division from scratch. But one new department matters most to this story: mortgages. A mortgage is just a loan people take out to buy a house. You borrow money, pay it back over 30 years with interest. Simple. But Lehman has a plan. They buy two actual mortgage companies, Aurora Loan Services and BNC Mortgage, so they can make loans themselves. Then they bundle thousands of those loans together and sell the bundle to big investors like pension funds. Pension funds are the giant pools of money that pay retirees their monthly checks. The pension fund gets steady monthly income from all those homeowners paying interest. Lehman collects a fee for packaging it. Everyone wins, in theory. By 2007, the machine is humming. $4.2 billion in profit, $19 billion in revenue, $640 billion in total assets. Dick Fold is a hero. The bonuses are obscene, except for one number nobody wants to talk about. Of those $640 billion in assets, only $22 billion actually belonged to Lehman. The rest, over $600 billion, was borrowed money. Here's why that's terrifying. Imagine you want to flip a house. You have $10,000 saved. Instead of buying a $10,000 house, you borrow $290,000 extra and buy a $300,000 house. If the value goes up, amazing. But if it drops by just 4%, you've wiped out every dollar you own, and you still owe the bank $290,000. That was Lehman Brothers, at a scale of hundreds of billions, and their mortgage department was sitting on a mountain of loans they couldn't sell fast enough because home prices were starting to fall and big investors were losing their appetite for mortgage bundles. Warnings came. An investor named David Einhorn stood up in early 2008 and publicly said, "Lehman's numbers don't add up. The risk is way bigger than they're admitting." Lehman's response? Basically, sit down. The music was still playing. Nobody wanted to be the one to stop dancing. September 12th, 2008, Friday evening. Every major bank CEO in America gets called to the New York Federal Reserve. Emergency meeting. Dick Fold doesn't get that call. The people in that room are trying to figure out how to stop Lehman from blowing up the entire financial system on Monday morning. A few months earlier, a bank called Bear Stearns had been rescued. JP Morgan bought them, and the Federal Reserve covered $30 billion in bad debt. But the public was furious. Taxpayer money bailing out Wall Street. Election coming. Nobody wanted to touch that again. Barclays tries to buy Lehman over the weekend. UK regulators block it at the last minute. Bank of America walks away and buys Merrill Lynch instead. No buyer, no bailout, no backup plan. 1:45 a.m., Monday, September 15th. The email goes out. The stock market has its worst day since September 11th. Money market funds, basically the accounts companies use to pay employees, start failing. Banks around the world stop lending to each other because nobody knows who else is secretly holding the same toxic mortgage bundles. The invisible plumbing that keeps the economy running seizes up all at once. And on the ground, real people. Lehman employees watch their entire net worth hit zero before breakfast. Retirees open their account statements and the numbers make no sense. 8 million Americans lose their jobs over the next 18 months. People nowhere near Wall Street, having nothing to do with any of this. Congress passed the Dodd-Frank Act in 2010. New rules, mandatory stress tests for big banks, restrictions on the riskiest activities. Dick Fold was never charged. He lost hundreds of millions in Lehman stock himself. Barclays bought the U.S. operations out of bankruptcy for $1.75 billion, an absolute steal. One person went to prison for the entire 2008 financial crisis. One, a junior trader, out in under 2 years. Lehman Brothers survived a civil war, 2 world wars, the Great Depression, 9/11, 158 years of reinventing, adapting, always following the money. And in the end, none of that history could save them from one simple belief shared by almost everyone in that building, that they were too smart for consequences. The scariest part isn't that it happened. The scariest part is that belief never actually went away. It just changed its address. If you want to see where the next version of this story is already being written, stay tuned. That video is coming. And if you made it this far, drop the word cotton in the comments. You'll know why.